Money and Me on Your Money, only on MoneyFM 89.3.
He says you should never take investment advice from someone who isn't a successful investor. So we're taking him at his word. And featuring Luke Ho, Director of Sales at Financial Services at Trillion Financial Planners. Here to help us understand, we gave him imaginatively $10,000 and said, okay, where would you put that cash? Where would you park it in today's market? And he's game enough to share with us how he thinks through investment strategies. He says he's usually used to six-figure portfolios, so we're very grateful that he's helping us think through first $10,000 and then $200,000 in the stock market today. First up, time to say good morning. How are you, Luke?
Hi, good morning.
Good
I'm
morning.
good.
You're good today? Wonderful. So I read your blog post and, you speak quite openly of your own lessons. You see, in late 2016, you came across a particular fund. Was it a
Oh, yeah. Yeah, it was a fun.
You thought that it was going to pay out a dividend of 7.2%, but it was going to pay out 7.2 cents.
Per unit, yeah.
Per unit, right? 7.2 cents per unit. And why would that turn out to be a significant investment blunder for you eventually?
I think it's because the allocated payout of cents per unit depends on the price of the unit. So if the unit price is lower, then the fund manager is obligated to pay out a significantly higher amount of cents. So let's say if I buy the unit for $1, it'll pay out 7.2 cents, which is 7.2%. But at 80 cents, it would pay out 9 cents, basically. So as in the ratio of having bought that. So what will happen eventually is that if the fund can't keep up with the amount that it's supposed to pay out, then the unit price will continue to drop and it'll create a vicious cycle where they are just continually paying out the capital until the capital depreciates to quite a staggering point. So in the case study, which was back in 2016 that I experienced myself personally, they were paying out at one point somewhere between 11 and 13% across the year, but the fund value had dropped to almost 23 by then. So it was quite brutal, a very difficult lesson.
Okay, so what was the key lesson there? You need to be looking at what do you need to be looking at beyond what you were looking at?
Ultimately, you want to look at, first of all, the fundamentals of where the money would come from, whether or not it can be supported, whether or not there's a history of it having been supported, of course. Some of those little things will help. And then, some of that is about sustainability. I guess, mostly along those lines, some of the projections can be quite unrealistic if you look at the background, the fund manager or the fund house, and you see that they've overstretched themselves in this particular area. So a lot of those things would have been good considerations before investing in that. And then, of course, having a clear understanding of what dividend means in the professional market, because in a professional market, at least for when you're dealing with clients or whatever, the term dividend can be a lot looser than the actual definition of dividend. Dividend is supposed to be in reference to profits, but when you're looking at the finance market in Singapore, so dividend can be used to refer to anything. It can be used to refer to a bond coupon, a stock dividend. It can be used to even refer to REIT rental income, and where it comes from really matters in relation to its sustainability. So those things would have been good to know before investing.
That's a great nuanced approach. And you say also in this article, it's a good idea for investors to clarify everything. So if they're not sure about what the term dividend means, they should ask, right?
Oh, yeah. I think there's a lot of investors today who are pretty scared of asking questions like this because
it sounds so basic. Yeah,
like you don't like it's something that you could Google, right? And they don't want to seem foolish in front of their peers or if they are part of finance groups. And so what happens is that they eventually overlook this particular area, and it could have huge negative financial repercussions.
That's a great point, Luke. Okay, so we're thrilled that you're going to help us understand how you would spend the $10,000 that we gave you imaginatively in just a while. But first, can you tell us about how you got started with investing?
Incidentally, I got started with investing mostly along the lines of that particular story. So I joined the financial industry about 2016, early 2017, and I didn't know anything about investing at the time. So there was this particular up and coming fund that seemed very promising. Because I mean, if you look at it definitionally, it says dividends, they'll pay out this kind of dividend. So I just kind of thought that it was a good idea, and I sold it myself. I bought it myself, sold it to a bunch of clients, and it started to become quite unsustainable. And that after a couple of months, instead of trying to figure out how to solve that particular fund, eventually what I did was to just kind of port my clients into something else, which I felt was more appropriate. I think that the experience kind of taught me that it's very, very important for you to really have a very clear understanding of what kind of expectations certain assets would have. So if that particular fund only had a very mixed asset allocation, it was quite unrealistic to expect it to pay out like a 9% dividend, for example, without having any kind of financial repercussions. So that was when I really started to deep dive into every asset class, every geography, to kind of get a clear understanding of what expectations I should have for investing in the future, as well as how my clients' investments could perform.
So how did you get better at investing? A lot of people know there's so much free information out there, newsletters you can subscribe to, some you have to pay for, some you don't. How did you get better, and what do you use to determine whether it's a good source of information or a poor source of financial information?
The second part, in some sense, I was quite fortunate because I don't actually have a financial background. So I actually studied media and communications for both my diploma and my degree. So filtering poor financial news is usually, or just news in general, is not very difficult for me. Usually you would want to look at the history of how the news outlet has printed out sources and whether or not they have any like financial incentives to say or do certain things, as well as whether or not that particular track record of the things that they've said has lined up with the market. So adding that with my gained financial knowledge is usually not very difficult to process whether or not a bit of financial knowledge is useful or not useful for the long term, or whether it's reliable. Sorry, what was the first part of the question again?
Well, you said you joined the industry without specialized knowledge. So how did you get better at investing?
I think the breaking through point came for me when that particular incident happened. So I was quite it's really something
sobered
very,
up. It was
but
sobering,
honestly, because it's not just your money, right? So it was one thing for me to toss my money into that, and it's another thing for you to tell your first few clients, because you're new to the industry, to go and do something like this when you weren't really that sure to begin with, and then these guys lost money because of a decision that you made.
Right.
And so that really has that kind of impact on you. But for myself, I think the point where I really started to understand a lot better was when I was visiting my sister in the United States. So the United States is really the investment capital of everything. The currency is US, the global currency is in USD, and the resources there are really insane for learning how to invest and things like that. So during the time that I was visiting her, I spent a lot of time at Barnes and Nobles and other book places. I read about maybe like 12 to 13 books in a span of less than 6 days. And then I processed a lot of the information and started writing about it. So that was in 2018, which was incidentally the point where I decided to create my blog, Money Maverick. And the reception was very good, and a lot of the investment returns lined up with the things I had learned. So I started trying practical application as much as possible up to this point. So my annualized return since 2017, after the initial fiasco, about 24, 25.
Wow.
In the last 4 years.
Very impressive. Incredible.
On average.
All right. Well, we're glad to have you here with us. Now, you tell us that you're used to portfolio sizes of about 200,000 or so, but we asked you to help us out. How would an investor with $10,000, so not that big a sum to risk losing, where would you park that cash in today's market? And this is interesting for us because it also tells us, helps us understand your approach to cash in today's market.
So this is on the basis that the investor has 10,000, right? Not myself personally.
No, yeah, it's any investor, yeah. But how would you think through it?
Usually I'll run through with them for example, why they have the $10,000 investment to begin with. So there are some people who maybe they have this kind of cash because they are looking to lower their renovation loan, for example, or to have a slightly better down payment. In that case, you need to put them to something fairly safer and defensive because the timeline for that is very short. Means if you want to sell it at a price that's higher than $10,000, you need to put them to something that is fairly conservative. But if you're looking more long term, which is much more my specialty, I'd say currently, personally, I have quite a bit of interest in India and China, and of course, specialized sectors. Yeah.
Okay. So what sectors are you looking at in India and China? Are you looking at the tech economy? Are you looking at anything to do with infrastructure supporting 5G? Can you share more?
Tech is definitely a sector that we've all been looking at for the last couple of years, even though tech technically internationally has been overvalued for at least the last 5 or 6 years. I think it's just simply because, especially during times like COVID, we've seen that tech can really do very impressive things. In the past, like not that long ago, actually, in the last couple of financial crises, we would consider food and health defensive sectors. Means that during financial crises, you should expect that food and health will be able to either have some kind of decent yield, or maybe they will only have reduced losses compared to the rest of the market, because usually during a crisis, economic or otherwise, you would find that people still need to eat and they still need to watch after their health. So typically that's where you expect the money to go, especially during times like COVID. All the more you would expect that to happen. But the results for COVID have been really very mixed, because food is so closely tied to property, and obviously property had to suffer because not a lot of us could move around and shop at like restaurants or whatever. And then on the health side, I think that people have really overestimated what kind of money goes into health, not because there's very little money going to health or anything, but because every health company is trying to get a part of being part of COVID. So some of them will have like grants to try and do this or be part of that solution, this solution. And a lot of it won't work out, especially if it's hard to vet properly. Like everyone's desperate to get something done quickly. So a lot of money gets wasted in between because people can't deliver on what they are contracted to do. And then subsequently, other health companies which don't specialize in like disease areas, for example, like the majority of all of this kind of R&D or research would have gone towards fixing things before, like tuberculosis, for example. And when attention gets pulled away from that, the health industry suffers as well. So you had a lot of mixed results in what should have been sectors that made money during this period in COVID. And so instead, you can look at an area like tech, where tech has obviously been what's keeping us alive to some degree. Everyone's had to look at it for entertainment, for your cute little safe entry things. And it's likely that trend will continue in the future. So that's obviously why investors like myself and pretty much everyone else, to be fair, they will be looking at tech as a sector. For India and China, it's much more... Oh, sorry. You're saying?
No, go ahead.
Oh, no. So for India and China, it's much more in relation to how those countries are valued at the moment, how they were impacted by COVID, as well as where they think that they'll move on from here in the future. I think that the US has been uncertain for quite a while. So it's not that I'm not into the US market. It's just that, frankly speaking, India is undervalued for... India has been undervalued for quite a while, and it was even more undervalued due to getting hit both by COVID and the oil situation. So it seems like because India has a very long history of decent market performance, that buying it at a discount makes a lot of sense, regardless of whether or not COVID seems like a thing that will stay there. Like there's really like thousands of people suffering in India every day, especially much more there than in Singapore. But as an investment, I mean, not to be mean or anything, but from an investment standpoint, it seems like a freebie.
Like an opportunity.
Yeah. I mean, it really is. So, and hopefully the money will go towards helping the economy and population there as well.
What sectors in India,
just
though?
Things like that. Sorry?
Which sectors in India?
I mean, personally, I'm still quite a big fan of the banks there. I mean, and that may be a little unusual answer, but I've always admired some of the domestic banks there, as well as the domestic financial approaches. It's not very well known or documented, but India has some of the best domestic mutual funds in the world. and their banks, like HDFC for example, have always been very strong fundamentally. So I think a lot of third world countries, not say third world countries, like let's say your APEC areas like Thailand, and Vietnam and all that, the lending of money for when people need it or their application for those loans has been quite a disaster. Even here also, I think you can see to some degree it's been a disaster. The major banks are suffering quite a bit. A lot of their benefits have been cut back over and over again. But I think based on how India's used to this stuff, you know what I mean? They've had like 40, 50 years of having to deal with very difficult financial situations like this. So I think that they will distribute that money a lot more effectively to the people in relation to rebuilding. And so that's usually why they have such high growth. Yeah, so that's one area.
Okay, is your investment strategy, I mean, how often do you sort of recalibrate your portfolio? Say you were looking at 200,000 instead of 10,000. We're looking at a different quantum. Does your strategy change?
It does to some degree. So I mean, for myself personally, my portfolio does happen to be about 200,000. Slightly more, I guess, if you count my land in Thailand. But I guess about maybe 90% of that would go into something which I'll consider a safe asset, and then about 20,000 would go towards very risky assets. It's to do with this thing called the Barbell Strategy. Yeah.
Okay, so a barbell has two ends. One end is the risky assets, and the other end is the growth basket, right?
Yeah. So it's a very basically the safer end is what you consider definitionally safer to you. Some people would do CPF on one end, means it's very steady, they predictable return, and then the other end for them would be maybe like individual stock picking. So for myself, my safe end is usually in relation to unit trusts or exchange traded funds in some of these countries and sectors that I mentioned. And then that 10% or that remaining 20,000 out of the 200,000 would be in something considerably more risky with maybe like options, peer-to-peer bonds, something that would hopefully do at least 24%. For me, that's my margin for taking that kind of risk, 24% or higher.
Okay. I see you have a thought of putting 5% towards crypto, so you look at crypto as a hedge?
Oh, yeah. I guess usually hedging is in relation to, like, at least from the dialogue that I have with traders and speculators, they usually refer to hedging as something that kind of offsets their risk, but crypto is not exactly something that necessarily does that.
So why is it in your basket? Yeah.
Why is it in my basket? I guess partly it's because I couldn't get rid of it.
Couldn't get rid of it?
I got some crypto back in 2018.
This is not Bitcoin, right?
No, I got Ethereum and a couple of the other altcoins. So you can actually get rid of it, it's just that I was reluctant to sell it at a loss at that particular point in time. That being said, of course, some crypto is good to. I guess there's a lot of talk, for example, from famous writers like Robert Kiyosaki who talk about the fall of currency, and so I think it's good from a speculative point of view if you want to do something extremely risky on that 10% end. If you really think that the rest of your portfolio had risk of collapsing, then yeah, hedging actually. Then you would buy some crypto on a regular basis even. So maybe out of every $100 you invest, you could put like somewhere between $2 to $5 in crypto. At least I would probably do that personally.
That's interesting. And which altcoins would you be looking at, or are you looking at Bitcoin?
Probably currently now I'll probably be looking at Bitcoin. Altcoins are even more speculative than Bitcoin, so I don't necessarily like that too much. There are some of my kids, I mean not my kids, some of my clients really they really like some of the altcoins, and from what I've heard, there's really a lot of potential there in terms of like privacy and security, a lot of practical applications for the blockchain. But for myself personally, I think that I've speculated quite enough in my line of work already, and most of my assets, even my safe portfolio, are fairly risky, so I probably couldn't take on any more altcoin than I already have. Yeah.
Okay, so what are some common examples that you see people, clients or people that you know using in line with this philosophy of the barbell? And it sounds like one end is more heavily weighted than the other. If it's 90%, it's not exactly sort of, it doesn't fit our image of the barbell of 50-50, right?
Oh, yeah, that's true. That's a great point. So the reason for that is in relation to, so just to explain the barbell strategy a bit, it's basically just the idea there is to suggest that the reward risk threshold for being a long-term investor, so this is a long-term investing concept, is that you should do extreme high risk and extreme lower risk, or whatever is your category of lower risk. So what will happen is that the maximum drawdown that you can have on the extreme risk end is 10%. So you can't actually lose more than 10% of your portfolio across the long term, assuming that that's the case. Well, at the same time, right, what happens is that particular 10%, because it's in such risky assets, has a massive upside potential. So that upside potential could be so high, or basically the ratio of your risk to the rest of your portfolio, that 10% versus the 90, should be so high, right, that it could be as much as the safe side. So let's say I have $200,000, I got 180 in one corner, I got 20,000 in one corner. That $20,000 should be invested in something that has so much upside potential that it could go up as high as $180,000, which balances out the barbell.
I see.
Yeah.
Well, thank you so much for letting us into your thought processes and being so sporting enough to take on investing $10,000 hypothetically for us, Luke. Great getting to know you.
Oh, thank you so much. Yes, I enjoyed myself.
Wonderful. He's Luke Ho, Director of Sales Financial Services at Trillion Financial Planners, telling us a little bit more about his own journey as an investor. And you can read more from him at moneymavericofficial.com.
Before acting on the information on Money
Thank you.
FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at MoneyFM893.sg or download the SPH radio app available on Google Play or the App Store.